43 minutes left of trading. Shares of Campbell Soup higher today after beating earnings estimates. But organic revenue growth came in a little lighter than expected. I spoke with Campbell CEO Mark Klaus this afternoon about the company's overall sales picture right now. Here's how he characterizes it.
We felt good about the quarter. I mean, we had anticipated that we were lapping a fairly significant replenishment of retailer inventory a year ago. If you remember, at that time, our meals and beverage business was up 11%. Soup was up 21%. So we were lapping some pretty tough comps. I think along with that, though, a little bit of headwinds relative to supply, primarily related to labor. And we're doing a really good job of working through that, but a little bit of short-term pressure on us in the quarter. But overall, very aligned with our expectations. And I think it was paired with a very good delivery on the other financial metrics. And, you know, tough environment for sure, but I think navigating it well.
Talk to us more about what you're experiencing on the labor side of things. How tough is it, and how are you fighting that issue?
Yeah, no, great question. In Q1, our labor, so as a percent of vacancies within our network, was about 13%. You know, we average usually around 4 or 5%. So it was almost 2 to 3 times what a normal vacancy rate would be. But we did jump on it with a lot of activities, and we're kind of approaching it through kind of 3 levels. First is the acquisition, then the conversion or the hiring, and then retention. And really all 3 of those are important. And what we found is that it's really a combination of tools that are getting the job done. And, you know, whether that's, you know, sign-on bonuses and wages, some of the financial elements that you would kind of expect, but also really important is the support we're putting around new employees, especially whether it's the training and development that we're providing, or the management or resources, or even the scheduling, which has proven to be a big factor. So the good news is, in the last month, that vacancy rate that we had in the first quarter has come down by 30%. So we're making great progress. I do expect, as we turn the calendar year, to be in a more normalized position as we get into January and February. And then with that, I would expect to see supply and inventory levels on those specific places where we're a bit challenged now to recover fully. So we're looking forward to that, but a lot of progress here in the last 30 days.
So on the pricing front, a lot of analysts were looking for you to pass on those higher prices to consumers. We saw that in this report a little bit. I wouldn't say to a greater extent. Are higher prices, how much more room is there for that? And are higher prices going to keep going up?
Yeah, I mean, we said today that in the quarter we saw inflation rates that were around 6%, and that we expect the full year to be in the high single digits, which implies some increase in inflation as we go forward. That is expected. We understood that. And so what we have planned is a second round of pricing that we've already communicated to retailers. It'll take effect in January. It'll bring for the full year our pricing level to around mid-single digits. And then when we pair that with our productivity and some of our cost savings initiatives, as we get into the back half of the year, we expect to be able to fully offset inflation with a combination of those tools. In Q2, we'll see a little bit of tension between that rising inflation and as pricing comes into effect. But by the time we're in the back half of the year, we're feeling very good about our position and our ability to mitigate that inflation in the second half. And I think with that, you'll see momentum and acceleration of our performance through the second half and heading into 23.
So from your perspective, overall food inflation peaks, sometime next year, early next year?
Yeah, I mean, I think it depends a little bit as you're watching the, you know, kind of the ups and downs over the last couple months. There are some places that you're starting to get some early signs of recovery and some costs that are going down. But there's other places where I expect it to stay with us for a while. You know, one of the things that's affecting our back half in particular is packaging prices, where a lot of those contracts are more on the calendar year than our fiscal year. And so as we get to that January timeframe, we'll see a little bit of a bump up. But I think overall this inflation falls into a mix of some things that are generally cyclic in nature, and I think we'll recover over time. And then I think some things that are a little more structural. When you think about wages and labor costs, along with some of the transportation costs, I expect those to stay with us. And so we're, you know, working appropriately on the right things for productivity and price pack architecture, and other tools that we've got to minimize the amount of impact that consumers have to experience on price. But I don't think we should anticipate inflation leaving anytime soon.